Most people make a money choice in their 20s or 30s, and by the time they hit 40, they're regretting it. It doesn't feel dangerous at first. It feels normal. But this single decision quietly determines whether your financial future is secure or stuck. In this video, we're exposing the money choice most people will regret by 40, why it happens, and how you can avoid making the same mistake. Before we dive in, if you want actionable advice to protect your future wealth, hit subscribe. Not investing early enough. The money choice most people regret by 40 is waiting too long to start investing. In your 20s, investing feels unnecessary. You're focused on paying off student loans, building your career, or just enjoying life. Retirement seems so far away that it's easy to put off. But here's what most people don't realize until it's too late. Every year you wait to invest costs you exponentially more than the money you would have put in. $1 invested at 25 is worth so much more than $1 invested at 35 because of compound growth. When you're young, time is your most valuable asset. You can afford to take risks, ride out market downturns, and let your investments grow for decades. Once you hit 40, you've lost half of that time advantage. You can't get those years back, and no amount of aggressive saving later can fully make up for starting late. The people who retire comfortably aren't necessarily the ones who earn the most. They're the ones who started investing early and stayed consistent. Why people put off investing? The biggest reason people delay investing is fear and confusion. The stock market feels complicated and risky. There's so much information out there that it's overwhelming. People worry they'll lose their money or make the wrong choice, so they do nothing. Another reason is the illusion of having time. When you're 25 or 30, 40 seems forever away. You think you'll start investing next year or after you get that promotion. But next year turns into 5 years, and suddenly you're approaching 40 with little to no retirement savings. Many people also prioritize other financial goals first. They want to pay off debt, save for a house, or build an emergency fund. While these goals matter, completely ignoring investing until they're done is a mistake. You can do multiple things at once, even if it means investing small amounts while tackling other goals. There's also lifestyle creep. As your income increases, your spending increases to match it. That raise you got could have gone straight into investments, but instead it went toward a nicer apartment, a better car, or more expensive dinners. You end up earning more, but saving the same amount or even less than before. The real cost of waiting. Let's break down the numbers so you can see exactly what waiting costs you. If you invest $300 a month starting at age 25, with an average 7% annual return, you'll have about $730,000 by age 65. That's 40 years of growth. Now, let's say you wait until 35 to start investing the same $300 per month. By 65, you'll have about $340,000. You lost nearly $400,000 just by waiting 10 years. That's the power of compound interest, working against you instead of for you. Even worse, imagine waiting until 45. Your $300 per month would only grow to about $150,000 by 65. That's less than a quarter of what you could have had if you started at 25. These numbers assume the same monthly contribution. In reality, someone starting at 45 would need to invest over $1,000 per month to catch up to someone who started at 25 investing just $300. Most people can't afford to do that, which is why the regret is so deep. It's not about how much you make. Here's something that surprises people. Building wealth through investing isn't about having a high income. It's about starting early and being consistent. Someone earning $50,000 a year who starts investing at 23 can end up wealthier than someone earning $100,000 a year who starts at 38. The difference is time and consistency, not salary. You don't need thousands of dollars to start investing. Many platforms let you begin with as little as $50 or $100. Some even allow fractional shares, meaning you can invest whatever you have. The barrier to entry has never been lower. What matters most is developing the habit. When you invest regularly, even small amounts, you're training yourself to prioritize your future. As your income grows, you can increase your investments. But the foundation is built by starting now, regardless of how much you have. What you should invest in. For most people, the simplest and most effective investment strategy is index funds. These are funds that track the overall market, like the S&P 500. They're diversified, low cost, and historically have provided solid returns over the long term. You don't need to pick individual stocks or try to time the market. Index funds give you exposure to hundreds of companies at once, which spreads out your risk. Over decades, the market has consistently trended upward, despite short-term crashes and downturns. If your employer offers a retirement account like a 401k with matching contributions, that should be your first investment priority. Employer matching is literally free money. If they match up to 5% and you're not contributing at least that much, you're leaving money on the table. After maxing out any employer match, consider opening an individual retirement account, or IRA. These accounts offer tax advantages that help your money grow faster. Starting at 40 isn't the end. If you're 40 or older, don't panic. You still have time. With 25+ years until retirement, your investments can still grow significantly. The key is to start now and save aggressively. Aim for 20 to 25% of your income instead of 10 to 15%. Cut unnecessary expenses and invest the difference. Stay invested through market downturns. Don't panic sell. Consider working a few extra years. Delaying retirement to 68 or 70 gives your money more time to grow and reduces the years it needs to last. Other money regrets by 40. Many people regret more than just not investing early. Taking on too much consumer debt, especially high-interest credit cards for things that lose value, costs thousands in interest and sticks around for years. Not building an emergency fund is another regret. Unexpected expenses like medical bills, car repairs, or job loss can wipe out progress. Many also wish they'd negotiated salary and job offers better, as failing to do so can cost hundreds of thousands over a career. Lastly, lifestyle inflation is a common mistake. Spending more as income grows instead of living below your means and investing the difference. How to avoid this regret? The solution is simple. Start investing now. Open an account this week, even with $50. Set up automatic monthly contributions so it happens without thinking. Learn basic investing, compound interest, and diversification matter. Don't compare yourself to others. Focus on your own goals. Ignore media fear. Staying invested through ups and downs grows wealth over time. The hardest part about this choice isn't that it's irreversible. It's that most people don't realize the consequences until decades later. Recognizing it now gives you the rare advantage, time to fix it. So ask yourself honestly, is this a decision you've already made, or one you can still avoid? Share your thoughts in the comments. If this video helped you see the long-term impact of a single financial decision, don't forget to like, subscribe, and share it with someone who could use this wake-up call. Thanks for watching. I'll see you in the next one.